They say there's no sure thing in life except death, taxes, and the S&P 500. Anyone who's owned an S&P 500 index fund for long enough will tell you what a good decision that's been. If you'd put just $200 a month into the S&P 500 since January 2000, you'd have $350,000 today, assuming you reinvested dividends. Not adjusted for inflation, that's a 459% return, with the market at all-time highs. This teaches us a valuable lesson because most people don't question this investment strategy. They understand stocks go up, sometimes they go down, but it's common wisdom that buying the S&P 500 is the best retirement strategy, better than saving in cash. Until you look at the numbers and start comparing. This is for anyone who just started their journey with precious metals, or questioned whether they're setting themselves up for another 2011-style disappointment after the latest pullback. Because if you had invested $200 a month equally into silver, gold, and the S&P 500, assuming a 10% premium above spot for metals, and a modest 1.5% fee for buying and holding stocks, the metals in both cases have outperformed. Silver is up 533% since 2000. Gold is up 493% over that same period. The S&P 500 is up 459% since 2000 on that $200 monthly plan. And that's with dividends reinvested. That may surprise some people. Others may complain about difficulties selling metals during the recent run-up. So I want to talk about using gold and silver to retire, if it's still safe considering the recent pullback and market volatility. Then I want to show you how much gold and silver you need to retire in 2026. And we'll finish by talking about balancing a portfolio to make sure you're not only safe, but diversified and generating income. With recent volatility in gold and silver prices, some people have asked if it's still safe to have gold and silver as a key pillar of a retirement plan. You can't live in just one moment in time and judge everything that came before and everything since versus that one moment. Although we saw a major move up during the last 2 weeks of January this year for both gold and silver, followed by an unprecedented single-day pullback on January 30th, it's important to note that even if you had started stacking gold and silver in 2010, leading into the major blow-off top of 2011, you still would have tripled your money in gold today. With silver, you would have beaten the S&P 500 even when including dividends, even having paid $50 for silver in April 2011. These are facts everyone stacking precious metals for long-term savings needs to understand. Dividend yields for the S&P 500 are falling, meaning dividends are going down, making it a less attractive option for retirees looking to compound growth. Precious metals, on the other side, continue to reprice themselves as gold slowly replaces the US dollar as the preferred reserve asset for central banks, and silver supply simply can't keep up with demand on both industrial and investment sides. This is why, despite recent volatility for gold and silver, having them as a core part of your retirement plan is a must-have, not just a nice-to-have. If you're playing the long game to build wealth over time, which is what preparing for retirement is, you need to remember, statistically speaking, it's easier to be right about one or two simple things over a long period than to be right about 100 complicated things over multiple short periods. That's a trap people trying to get rich usually fall into. The day trading trap. Since the fundamental reasons to own gold and silver haven't changed, and they're still safe to have as a core element of your retirement plan, the question is, how much gold and silver do you need to retire in 2026? There's a myth many people believe. You need $2 million to retire. According to the American Senior Citizens League, about 56% of seniors retiring in the USA retire with less than $50,000 in savings, and rely almost entirely on Social Security to cover expenses. That's the truth. For people retiring at 67 and planning on living to 82, based on average monthly expenses for a retiree in 5 different countries, you need anywhere from about $100,000 in Germany to supplement a basic retirement, up to about $250,000 in the United States and Canada, factoring in average Social Security payments. That range rises to between $400,000 and $500,000 if you want a more comfortable retirement that includes travel and other simple luxuries. Depending on what percentage of a basic retirement you choose to fund with gold and silver, showing a range from 10% coverage all the way up to 100% coverage at an 80% allocation to gold and 20% allocation to silver, you may need as little as a few ounces of gold and 50 ounces of silver, up to as much as 40 ounces of gold and 600 ounces of silver, just to meet basic retirement needs. For the amounts needed for a comfortable retirement, I think the 10% and 25% retirement plans are ones people should build their first-level retirement targets around, and build up from there if possible. You should be aiming to get about 10 ounces of gold and 250 ounces of silver, assuming you have other sources of retirement income, up to about 25 ounces of gold and 600 ounces of silver as a starting goal in a retirement stacking plan that should start today. That amount covers 25% of a comfortable retirement. Now, the reason to allocate 80% to gold and 20% to silver, even though I admit silver will outperform gold over the next couple years, it's almost a certainty, is because of lower downside volatility risk. The pullbacks for silver can be a lot bigger than for gold. We saw it on January 30th. For anyone planning retirement around these numbers, it gives enough exposure to silver to benefit from upside potential, while allowing you to sleep well at night, knowing that central banks and people rotating out of bonds and into gold have your back and offer higher stability to prices than we may expect for silver. In addition to positioning for a little more stability in retirement, we have to remember issues that arose during the last bout of silver price volatility, especially at local coin shops who found it very difficult to manage stocks and buy-sell pricing. No matter what you do or what amount of your retirement you decide to cover with gold and silver, remember pension plans like Social Security are running out of money all over the world. In the United States, the Congressional Budget Office is projecting Social Security will have to cut payments to recipients by 25% in 2033 and beyond, which may actually come much sooner. At which point, dollars are going to get printed like never before to fill the gap, which is precisely why holding gold and silver for long-term retirement savings makes such good sense, especially when you consider how much they've appreciated in value relative to prices of goods since 1968. An updated example shows how a Toyota Corolla has declined in price by more than 90% when measured in gold and nearly 70% when measured in silver, despite the sticker price in US dollars increasing by more than 1,200%. A more modern example shows how the price of an iPhone today is basically 80% less when measured in gold and silver than when it first launched back in 2007. These are long-term trends that mean much more than a temporary pullback in January 2026. I suspect that pullback will end up looking like a blip on the screen by January next year, because we've only just broken above long-term resistance for both gold and silver. It was only a few months ago we broke 45-year resistance for silver. That tells us this pullback was, and still is, a buying opportunity. Even if we get a second pullback in February, none of it will matter by end of the year or 2 or 3 years from now. Staying on a schedule is much more powerful than trying to time the market when the long-term trend of currency devaluation and metals appreciation relative to cost of living and cost of goods and services is such an obvious one. Now, let me address diversification beyond precious metals. A table can't stand on one leg. While I remain most bullish on mining stocks and precious metals, and mining stocks are the largest stock position I hold right now, nothing has changed with an especially bullish sentiment towards silver miners. Some silver miners have been up about 250% over the past year, reporting 118% growth in adjusted net income for fourth quarter 2025 versus fourth quarter 2024. These silver miners are hardly priced for $80 per ounce silver, where we're at today, let alone $100 silver, which we flirted with in January, and I'm certain we'll flirt with again very soon. Instead, they're priced for maybe $50 silver, which is a price we're not likely going to see again. I think we've already bottomed out on gold and probably silver too, with a small outside chance of a final flash crash for silver around February 20th. If we can get past that date, all of that will be behind us. Although I remain super bullish on precious metals and mining stocks, specifically silver miners, which I think are going to shock us in the next couple years, diversification matters. Many hard asset investors have large real estate positions, but when it comes to stocks, scaling into oil companies makes sense. The reason is that money market and savings accounts are giving less and less return, with it becoming very hard to get 4% or more on your cash if it's not tied to a temporary promotional deal. with oil stocks paying dividends of about 4% to 4.5%, with some paying even higher. Although they've shrunk a bit since stock prices went up, you can wait as long as it takes for oil to get to $100 a barrel. It's better than holding cash in money market and savings accounts, and you can reinvest dividends into stocks as you wait for that eventual return to $100 per barrel oil and possibly higher. Especially when you consider oil has never been cheaper since 1946, when measured in gold and silver, than it is today. If we're in the middle of a bull market for commodities, which I think we are, very much being driven by inflationary forces, then it's obvious oil is really the last one to move. It makes sense to take a position now. We're now seeing major oil stocks like ExxonMobil breaking out to the upside after a long period of sideways price consolidation, as oil prices stabilize above $60 per barrel. Although they may retest breakout support levels if we see issues on the stock market, overall downside risk on these stocks remains low, with dividends providing amazing cash flow potential, especially if you're looking for passive income in retirement. Since it's only early days still for this breakout in oil stocks, and we're also likely in the latter days of a recession that was never announced, that likely started in early 2024, these oil stocks are in a similar place to where mining stocks were back in early 2024, with admittedly a little less upside, since mining stocks were really criminally undervalued. From my point of view, this is a great option for people looking to protect their money with commodities and add diversification to the portfolio, especially if you had the feeling you may be overexposed to miners during the last pullback, during which time the oil stocks moved up. Since mining company margins or profitability can be negatively impacted by rising oil prices, since that's one of the largest input costs in the mining business, this is just another logical way to hedge your position in mining stocks if you have a large mining stock position. But don't do it blindly. Research winners in the sector. Don't do it all at once. Remember, scaling in can take weeks, can take months. Set a budget. Identify stocks you think are good. Be prepared to hold these stocks for more than 12 months to see results, as it rarely happens in just 12 days. Let me bring this together. Being right on one or two things for a long time builds more wealth than trying to be right on 100 different things over multiple short periods. Gold and silver have outperformed the S&P 500 since 2000, when dollar cost averaging monthly. A Toyota Corolla is 90% cheaper in gold terms than 1968, despite 1,200% higher dollar price. An iPhone is 80% cheaper in gold and silver than 2007. For basic retirement needs, you need 10 to 40 ounces of gold and 50 to 600 ounces of silver, depending on coverage level. For comfortable retirement, aim for 10 ounces gold and 250 ounces silver minimum, up to 25 ounces gold and 600 ounces silver. Allocate 80% gold, 20% silver for stability, despite silver's higher upside because pullback volatility is much greater. Social Security faces 25% cuts by 2033 or sooner. Dollar printing will accelerate to fill gaps. Silver miners are priced for $50 silver, not $80 or $100, offering significant upside. Oil stocks provide 4 to 4.5% dividends while waiting for $100 oil. Oil is cheapest versus gold and silver since 1946. Diversification across precious metals, mining stocks, oil stocks, and real estate creates stability. Scaling into positions over weeks or months reduces risk. Hold for 12 months minimum to see results. The long-term trend of currency devaluation and metals appreciation is undeniable. Recent pullbacks are buying opportunities. We've broken 45-year resistance for silver. January pullback will look like a blip by next January. Stay on schedule rather than timing markets. Be right about simple things over long periods rather than many complicated things over short periods. That's how wealth is built, retirement is secured, and you protect yourself from dollar printing covering Social Security shortfalls and government deficits. The fundamentals haven't changed. Position yourself now while accessible. Build your stack methodically, diversify intelligently, and give yourself security knowing that when Social Security cuts come, when dollar printing accelerates, when inflation erodes cash savings, you'll have positioned yourself in assets that have protected wealth for thousands of years.